Good morning from Seoul. Korean equities suffered their second worst session of the year on Thursday, with the Kospi closing down 7.89% at 7,648. Before the open today, we are formally in a crisis volatility regime, which under our framework widens every scenario band by a factor of 3.5 and forces a permanent crash scenario into the distribution. The single most important number on this page is not the decline itself, but the 10,160 contracts of Kospi 200 futures that foreign investors bought into the sell-off. Cash market panic and futures market accumulation rarely coexist for long, and resolving that tension is the theme of today's briefing. Let me walk through what actually broke. The index opened down 4.5%, clawed back to -2 by late morning, and then failed after 11 o'clock when institutional loss cuts hit the tape, closing on the lows. Individuals bought a record 7.46 trillion won of stock, while foreigners sold 4.9 trillion in cash equities. Samsung Electronics lost 9% and SKhainik's nearly 15%. Critically, financial holding companies, defense, and shipbuilding all closed higher. This was a deleveraging of the semiconductor trade, not a repricing of Korea. On the right, you can see our own accountability. The realized move fell into the gap between our bear floor and crash trigger, so we take a 15-point penalty on the prior modal scenario. And this morning, the bear floor is force widened to -8%, so that yesterday's move can never again land outside the map. Overnight gives us two contradictory tapes. On the bearish side, the Philadelphia Semiconductor Index fell another 5.5%, taking the two-day loss to nearly 12%, and Korea's night futures settled down 1.8%. Domestically, Mirai Asset raised margin requirements to 40%, which cues mechanical forced selling for this morning's open. On the supportive side, the June payrolls report came in at 57,000 against expectations above 110,000, taking rate hike risk off the table. The won rallied more than 15 won in the offshore market. The S&P was flat with the Dow at a record, and foreigners have now bought more than 15,000 futures contracts in 2 days. Most telling, Korea's own volatility index fell on a crash day. Implied vol declining into a 7.9% decline is the signature of panic exhaustion, not panic acceleration. The non-deliverable forward market confirms the direction with an even larger move, down more than 15 won from the Seoul spot fix after the payrolls miss. A strengthening won is normally the most reliable same-day signal of foreign re-entry into Korean equities. The complication is that equity night futures point almost 2% lower. When the currency and the futures disagree inside a crisis regime, our discipline is not to pick a winner, but to widen the scenario bands and let the distribution carry the uncertainty. Chain A is the semiconductor liquidation loop, 2 consecutive rotes in the Philadelphia index, feeding leveraged ETF unwinds and foreign cash selling in Samsung and Hynix. We expect only partial transmission because the fundamental tape moved the other way. Third quarter DRAM contract prices are seen rising 13 to 18%, and Samsung is reportedly in talks with Anthropic on 2-nanometer foundry work. Chain B is the payroll shock feeding a won rally and foreign futures accumulation. This is the supportive chain, and the spread between a global VIX at 16 and a local V Kospi at 86 tells you this is a Korean positioning event, not a global one. Chain C is the margin cascade, and it is the chain we respect most this morning. A 40% margin requirement colliding with a 10% two-day drawdown means forced supply at the open. Whether that supply is absorbed or snowballs is the difference between our base and bear scenarios. Here's the distribution for the next 24 hours, built off yesterday's close of 7,648. Bear is modal at 36%, with a band from -3.5% to -8%, or roughly 7,036 to 7,380 on the index. Base carries 34%, a gap down absorbed by won strength and the futures bid, with 7,400 holding. Bull is 15% and requires the offshore won below 1535, plus continued futures accumulation. The crash tail stays open at 15%, below -12%, sized at 1.5 times the bear floor, because the leveraged ETF complex in Hynix and Samsung remains a $19 and $12 billion accelerant. Two mechanical notes. The bear floor was force widened this morning so that it covers yesterday's realized loss, and the base scenario is capped at 40% in any high volatility regime to prevent central bias. The probabilities sum to 100. On positioning, the operative word is patience. We hold 55% cash and hedge 20% of net exposure, escalating to 30% with explicit tail hedges if the foreign futures bid reverses. We overweight the proven refuges, financial holding companies, defense, shipbuilding, and add power equipment, where LS Electric's direct current factory news collided with a 10% flow-driven decline. On the semiconductor majors, we are neutral with a staged entry plan. Samsung only into the 260,000 won zone, and Hynix only above its June support, in both cases after the private fund loss cut flow visibly exhausts. Nothing gets bought before 10:30 this morning. The margin call supply must print and clear first. And note the invalidation discipline. If 7,400 holds through 10:30, foreign futures extend beyond 5,000 contracts, and the offshore won breaks below 1530, we will kill the bear call intraday and reweight toward base and bull. A view without an exit condition is a position, not a framework. To close, the execution map. On the downside, 7,400 is the session's referendum. It is the expert consensus support and the boundary between our base and bear scenarios. Below that, 7,036 marks the bear floor, and 6,730 is crash territory, where circuit breakers come into play. On the upside, yesterday's open near 7,930 is the gap fill ceiling. The first 90 minutes decide everything. Measure the opening gap against the minus 1.8% futures print. Size the forced sale supply in the two megacaps. Confirm whether the foreign futures bid extends. Check that Thursday's arbitrage buying, the first basis normalization signal, continues. And then let 7,400 hold or break at 10:30. If it holds with the futures bid intact, the staged entry window opens into the most attractive valuation zone since April. If it breaks, the bear band is engaged and hedges go up. We will publish the full recalibration after the close. Thank you.